Don Luskin, you say the hottest stock market area is the inflation plays, natural resources, gold, oil, basic materials.
Hey, look, I don't just say it. I mean, it's a fact. The market's proven it. You know, since the credit market onset, the two best performing sectors are energy and basic materials. You know, it's just it's the verdict of the market. That's the place to be. It's been the best way to play the credit crisis on the long side, to bet on the inflationary response of the Federal Reserve to it.
By the way, we've got some long charts on the S&P and the Dow Jones for all the credit problems we've had. That's the energy index. Let's go to the S&P and the Dow Jones. The long chart's going back to 2003. You know, when you look at this whole picture, there we go. We're off 15% from the high, but this has basically been a 4.5 year rally, and these indexes are still up 75, 80%. All right, Joe B., thank you for this, and let me ask you what you think of Mr. Luskin's inflation, basic resources, gold, energy, commodity hypothesis.
Well, I really have to go back to supply and demand as what ultimately delivers a price for any commodity. And our economy is deleveraging. As it deleverages, it slows. And it has ripple effects around the world, including the Chinese, where their growth rate is slower. And as a consequence, inventories of these raw materials will back up, and ultimately the prices will come down. Speculative fervor has been out there for quite some time in these categories, and it looks to me like where investors would run into late in the game. So late cycle, speculative enthusiasm, the end of that cycle, and prices start to roll back down based upon the economic weakness.
So, Don, you hear Joe, speculative enthusiasm, and I would just call it, or I would just ask you, is this an old-fashioned bubble in commodities?
I don't see why. We have a global boom. We've got a Fed that's printing money with gay abandon to prevent the credit crisis from getting worse. We've got all the classic recipe ingredients for inflation and growth at the same time. So you see it in these inflation-sensitive, growth-sensitive commodities. I don't understand where Joe's coming from. I don't see how he can talk about a deleveraging on the one hand and a speculative blow-off on the other. Those two are contradictions.
Go ahead,
Not
Joe.
necessarily, because the timing doesn't necessarily follow exactly. Indeed, it's only now that we've come to grips with the fact the U.S. economy is actually slowing to essentially a zero growth rate. The Chinese growth rate has fell in half, and the inventories of these various commodities have risen. Now, the headline risk, whether it's Nigeria or Venezuela saber rattling, has all caused a stir in certain commodities, but I think these pass quickly. We saw a $100 a barrel in January. We backed off into the 80s. I don't see this being any different now, and the pressure, I think, on commodities in coming months will be lower, not higher.
Lower, not higher.
Joe, oil's at 100, not at 80. I hate to tell you.
Well,
the CRB research index is at all-time highs. Copper's challenging all-time highs.
Where'd that $100
the burden of proof is on you, my friend.
Don, where'd that $100 come from today in oil? That thing comes out of the blue. Honestly, nobody expected that. Where's that coming from? Because is the global economy strong?
No, it's Nigerian government perhaps rolling over, Venezuela going to battle with ExxonMobil, and that's where this stuff comes from. And the speculators
okay, so
come flying in while the inventories
keep going up. Is Nigeria causing the gold price to go up 25 bucks? How about the platinum price? How about burlap? How about zinc? How about copper?
Gold is going to be a function of what's happening in this delevering process, which has not been going too well. And as you have mentioned correctly, this fiscal stimulus package is not being applied directly. It's a money giveaway, and gold is going to reflect that on a near-term basis.
Don Luskin, what about one little sign out there in all this stuff? The U.S. dollar, the greenback, has been nicely flat, bottoming, looks like, for the last 3 months.
Yeah, that's because the European Central Bank is kind of singing along with Ben here. They're deciding that they've got to start inflating, too, as their economy slows a little bit. So that's creating the illusion that the dollar is strong. But an illusion is all it is. That just means the euro is starting to weaken.
All right. I just want to add one more thing. HP had terrific earnings. The stock went up 5% after hours. Joe Battipaglia, Don Luskin, I thank you for your wisdom and your brevity.